So you can see fiscal is obviously government, and monetary is obviously central banks and money bodies, basically, as you can see. So let's move on. Time value. So this is an equation that repeats across multiple different stuff, like 1 plus r times n. So there's this other equation, which is current value, or CF, so discounted cash flow. The equation is the first year's cash flow over the 1 plus r times n, which is essentially the n is the number of years, and the r is the interest rate and the present value, right? So in this case, it's the future value we're looking for. So that's present value times 1 plus r times n. So in most equations, this applies, as you can see. So as you can see, present value is future value over 1 plus r times n, which is the present value, right? So there's also discounted cash flow, like I mentioned. So that's CF for the number of years. So CF times to the power n over the 1 plus r times n, okay? So then we have internal rate of return, so IRR. So future value over the present value to the number of periods, number of years, and then minus 1, okay? So this is the equation for that. The average weighted capital cost of capital, as you can see. So we have so this is something that I want to leave for now, but just take note of this. And CAPM, which is capital asset pricing model, okay? So expected return, so there's a risk-free rate plus beta times a market return minus risk-free rate. So we'll come back to this because this is a little bit more of a it has more complexity to it. So causation is a cause and effect relationship between variables, where changes in one variable directly leads to changes in another, right? So PMT, right? PMT means, what does PMT stand for? Don't mind that. What is PMT? 1 second, guys. Let me close those. PMT stand for in finance. Okay, so okay, so payment. Okay, PMT stands for payment. All right. So payment equation is, payment formula is future value minus present deposits times 1 plus r times n, right? Once again, so as you can see, 1 plus r times n repeats once more, okay? So just keep repeating that, 1 plus r times n, okay? So we'll call it payment, and let's move on. So discounted cash flow, this is the equation that I was talking to you guys about. See, 1 plus r times n over the number of years over, you see, right here. Econ balance sheet. So of course, assets are things that make money versus liabilities are things that, take money away from you. This could be loans, this could be, overhead costs, the things that you don't see. So these are very important. So equity, so that's like how much people in the company own, like, percentages, right? So total assets minus total liabilities. So that's how you calculate how much money you really make, right? So as you can see, a method of accounting in which revenues and expenses are recorded as they're incurred, so HEC rules. Efficient market hypothesis is a hypothesis that states that share prices will reflect all information, and consistent alpha generation is impossible. So it's alpha generation, I believe. Let me use is alpha generation the attempt to predict future prices in finance? Let's see what it says. Yes, okay. So the alpha generation in finance is fundamentally attempting to predict the future prices and achieve returns above a benchmark, essentially beating the market, right? So yeah, this makes sense. So a hypothesis that reflects that all prices reflect, the share prices reflect all information, and consistent alpha generation is impossible, okay? So we have time series analysis, so it's just a regression chart from, understanding the patterns of how time goes over a certain period, right? It's qualitative, quantitative, this is common stuff. And for anyone wondering, this is just more numbers. This is statements based off stats. Corporate restructuring. So this is how a corporate organization works. So we have the organization level restructuring, financial and operational, right? So we can see the equity restructuring and the debt restructuring. So equity is what you own and debt is what you owe, right? So let's see what value at risk. So a statistic that quantifies the extent of possible financial losses within a firm, portfolio, or position over a specific time frame. So this is very common in hedge funds. So hedge funds essentially bet against a certain thing to cover for these losses, right? So as you can see, we have the median chart. So median is like how much values are closer to the the standard deviation is how much values are closer to the median. So if you see right side, it's obviously towards negative, and then left side is particularly positive. So you see there how much profits we have versus how much losses we have. So value at risk and value at return. So you see fiscal policies. Fiscal is government, and monetary is central bank, okay? Banking institutions that are centralized and controlled, okay? So LBO, which is leverage burnout. So this is the acquisition of a company. So basically, I'll show you guys a little diagram about this. So it's when you get a loan from the bank to acquire another company, that is funded using a significant amount of debt. Exactly. So net present value, once again, 1 plus r times n applies here, except it's in I don't understand this part, so it's like a minus what is the what is the minus c 0 in, I think it's the number of years in the net present value equation. Okay, let's see what this is about. The initial cash outflow or initial investment that is required to start a, right, okay. So then, oh, right. Okay, so the initial investment and then how many years it's going to keep repeating, right? So that's the net present value. So you see over here. And let's move on to the second page. So this is the internal rate of return. So you can see that 1 plus r times n is applicable here as well. See, internal rate of return time to the power n. So same thing as the DCF, discounted cash flows, except this one has the initial cash flow as 0, and then you know, it goes on just like this depending on from the first year onwards, right? So of course, actually initial investment, right? So how much you initially invest and then how much you can expect to get as a return, right? So that's the internal rate of return. So yeah, this is a little roadmap that I've got from GPT. So you can see that we have DCF, we have all these cash flows, discount rate, terminal value, summarize evaluation, and keep up. Yeah. So this is mergers and acquisitions. So that's when you merge with another company or acquire another company, usually using LBO, which is leverage burnout, which is basically borrowing money from a bank to acquire another company in hopes of making more profits from that company. Understand LBO structure and debt schedules. So of course we're going to get in debt to acquire another company, right? So as you can see, we have mergers and acquisitions in LBO models. Right, so let's move on. So once again, you can just go through this. I'm not gonna spend a lot of time here, but yeah, so we can see liabilities plus equity is assets, right? So liabilities is things that take money away from you, right? Equity is money that's gonna come your way. So let's move on to comparable company analysis. So this is where you see a chart with all the different companies. So you can see company 1, company B, like that. So we can see the different types. So I have questions about this part. So enterprise value, right? TEV and revenue, EBITDA. So these are key things that we need to look into. So TEV is enterprise value. EBITDA, I'm not too sure what this is. TEV, once again, enterprise value. And PE, which is profit and expense, I believe. PNE. PNE in finance, let's see. Profit and expense, I believe. Price to earnings, okay. So price to earnings, okay, so price earnings ratio, stock price over price earnings per share, right? So that's the ratio, okay. So price to earnings, okay. So stock price over earnings per share, right? So let me just copy this. Let's say, for example, econ. I think I already have this, but I need to refer to it again. Earnings ratio, so I put it so it comes down. So identify the industry, understand company description, and identify competitors, right? So that's comparing companies to acquire. And stock valuation, comparable company analysis. So you can see the market data, financial, and valuation. So if you want to take a look at this, so we have the different companies, as you can see, and this is the, once again, the evaluation. So let's call it evaluation so it's easier. But it's the enterprise value, okay? So we'll call it evaluation, okay? So enterprise value, let's call it that. And you can see sales, the EBITDA, the EBIT, the earning, and EV sales. So that's enterprise value sales. I don't get the EV EBITDA thing, EV EBIT. And this is once again price to earnings ratio, right? Different companies. So how much did we make over that period, right? So let's see, what else? So steps to perform precedented transaction analysis, search for relevant transactions, analyze and refine available transactions, determine a range of valuation multiples, and apply the valuation multiples to company in question, graph the results in football field chart. So let's see what this means. Search for relevant transactions. So that's basically this, and analyze and refine available transactions. So we can go into it. So once again, determine a range of valuation multiples, right? So these stuff, apply the valuation multiples into the company in question. Right, okay. Graph the results, football field chart. Right, okay. Does it perform present select a comparable universe and collect transaction data? So then calculate the transaction multiples, apply the multiples to the company being valued, right? Okay, interesting project that I could do again. So I'm going to call this, I'm going to have a few dots here. Okay, so you can see the stuff that you need to study. I think ROIC, let's see what this is about. Because we did We did NPV, this is net present value, IRR, which is internal rate of return, and ROIC is return on invested capital, right? Indicates how efficiently a company puts the capital under its control toward profitable investments and projects, right? So let's say, for example, econ, and let's say ROIC, right? ROIC, which is wait 1 second. So we see return on invested capital, right? Indicates how efficiently a company puts the capital under its control towards profitable investments or projects, right? So let's go with that for now. I need to get some examples because that's the way it goes in my head. Net operating profit after tax, invested capital. Right, okay. So this is ROIC formula. What's EBIT? What's EBIT? What is EBIT in finance? Company's operating profit. A company's operating profit without interest expenses and income taxes. Operating profit without interest expenses. All right. So then it goes back. Some goes into tax, and then debt plus equity minus excess cash. Money invested into the business. Right. Interesting. So let's say econ ROIC, and let's say. Okay, so let's go on. Except yeah. So fluency, right? Yahoo Finance, I've used this for trading. Edgar, have not used this. Ticker is like for, I think it's like for like getting the candlesticks, right? Yeah. Right, so it's a port. All right, okay, so to get the data and to extract key financial data from 10K reports. What is a 10K report? What is a 10K report? For what is it? Is an annual financial report that publicly traded companies in the United States must file with the Securities and Exchange Commission. Right, okay. 10K report provides comprehensive summary of a company's financial performance and business operations for the past fiscal year. This report is a crucial tool for investors, analysts, and other stakeholders to assess a company's Okay, so for IPO, like stock offerings and equity. Private venture capital, man. Oh my god. Let's say ROIC. Let's call this what is it? 10K report, right? So let's say copy this. Let's put this here. All right, let's move on. 10K reports. Three-statement model. Yeah, I've heard of this. DCF, once again, discounted cash flow. Leverage burnout. A comparable company analysis. That's what we did. Precedented transaction analysis. That's what we did with the data. Yeah. Okay, so you can see precedent transaction analysis. This is something we need to do another little study on. And yeah, so that's pretty much it for this part. I just want to slowly grasp my stuff. We were looking at, I believe, so mergers and acquisitions, pitch books, then to analyze synergies and deal structures, simulate how to pitch a company for sale or acquisition, deal experience simulation, so apply what you've learned in mock scenarios, do mock client presentations, build a pitch deck for a real or fictional company, walk through a model and explain your assumptions, practice answering common investment banking technical questions, right? Okay, this is an interesting factor. CFI, which is CPI is Consumer Price Index. What is CFI? Chief Finance, I don't know, certification, right? Right, so this is just general advice. Let's go here. So income statement, balance sheet. We looked at the balance sheet with the equity and the assets and liabilities. Cash flow statement, once again, the equations are really looking at. So work together. So we need to look into this. NPV, IRR, EBITDA, working capital. Okay. So once again, 1 plus R times N, time value of money. So time value of money is time value of money. This formula, a financial principle that states that the value of a dollar is worth more today than the value of a dollar in the future, right? So, all right, so that's a present value equation, right? So a financial principle that states that the value of a dollar is worth more today than the value of a dollar in the future, right? So that's, again, financial future value over the 1 plus R. So 1 plus R times N. In this case, it's 1 plus R, but in that formula, yeah, let me just double check with the formula. That's the present value. So 1 plus r times n, future value over 1 plus r, then this is the present value, right? But if you look at the future value, it's 1 plus r times n, and then the present value plus times the 1 plus r times n. So future value formula, you look at it again. So you see, present value times 1 plus r times n, right? That's the future value. So let's move on. So as you can see, we have the Excel and financial math. So you can use these tools on Excel. It's nothing complex. 10K downloaded 10K report from a public company. So I think 10K, let me see what does 10K stand for in finance. 10K refer to Form 10K, an annual report that the US public companies must file with the Securities and Exchange Commission, right? It's a comprehensive document providing it, right, so other people can invest in your company based on the reports of the past fiscal year. That's monetary, right? So yeah, cash flow, link income, balance sheet, cash flow, right? So revenue, build a 5-year forecast of its revenue, expenses, and net income, right? Link income, balance sheet, and cash flow, right? So okay, add assumptions, growth rates, margins, capex, depreciation. So usually in liabilities, vehicles, validate the assets equals liabilities plus equity, right? With a DCF, right? Run a comparable company analysis, right? So president, right? This is something that we need to look into. Mergers and acquisitions, buy side and sell side, mergers and right, and accretion and dilution. What's accretion and dilution? Is a financial statement assessment used in mergers and acquisitions to determine if a deal will increase or decrease the acquirer's earnings per share, right? Okay, so a financial assessment used in mergers and acquisition to determine if a deal will increase or decrease the acquirer's earnings per share, right? So accretion, right? So let me just get this. That's it, and this is the way I do it. So I just grab a useful, meaningful picture that will go with it. So let's look at the information here. Financial assessment that merges to determine if a deal. So let me see. I'm just gonna say to determine if a deal will increase or decrease the acquirer's earnings per share, right? So okay, so let's grab something that's useful. Acquirer's shares plus. So I believe for the moment being, this should be useful because it seems pretty simple, even though it seems more complex than it is. So let's grab this for now, and let's move on. Let's look at discounted cash flow. I think I was at here. Where was I? I don't know where I was. Okay, so I think I was at. Right, where was I? Okay, right here. Balance sheet, yep. And assumptions. Right. This is price to earnings ratio. The estimated what's this? This is the evaluation, right? It's basically valuation in EBITDA. I'm not too sure what this means. EBITDA seems like a pretty complex finance. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. The expense amortization is the expense of acquisition cost minus the residual value of intangible assets in a systematic manner. Interesting. In finance, EBITDA stands for earnings before interest, taxes, depreciation, and amortization. It's a financial metric used to assess a company's operating profitability, focusing on earnings generated from core business operations without the influence of capital structure, tax rates, and non-accounting cash items. Okay, valid. So let me just do that again. In finance, EBITDA stands for earnings before interest, taxes, depreciation, and amortization. Amortization is the expense of acquisition cost minus the residual value of intangible assets that in a systematic manner, right? Expense of acquisition cost minus the residual. Residual is how much it takes away, right? Remaining after, right. What remains after most of something is gone. So we'll do it with the meanings itself, so it's easier. So let's do. Let's grab. I'm gonna grab this and amortization. So let's do definitions within definitions. Okay. So we're gonna do amortization, and then we're going to do and residuals, which is residual value. So we're going to do residual value and residual value of something. All right, so let's move back here. EBITDA stands for earnings before interest, taxes, and depreciation, and amortization. It's a financial metric used to assess a company's operating profitability, focusing on earnings generated from core business operations without the influence of capital structure, tax rates, and non-accounting items. Cool, interesting. So let's do amortization. So amortization is, let's separate these. Counting. Cool. Okay. So let's go to finding some sort of YDU's measure of corporate profitability, which stands for earnings before interest, taxes, depreciation, right? So that's before money goes into taxes, pretty much. Interesting. So let me just grab this as well, so I can refer. Let me grab it, and yeah, I think that's fine. And this is more EBITDA, a company of a measure of a company's profitability, earnings before interest, taxes, depreciation, amortization. Right. This is a very convincing picture. Measure of a company's operating profit as a percentage of its revenue. Right. Okay. EBITDA margin. There's EBITDA minus revenue when divided by revenue. There's no 100 here. Interesting. Okay, so let me grab something. Give me a sec. Alright, so let's see. CFI, which is I don't know what CFI stands for. CFI. Corporate Finance Institute, right? Which is WSP. Context WSP requires to a professional service firm specializing in engineering and strategic advisory services, finance, funding and financing advisory, right? Right, okay. BIWS, what is that? Breaking into Wall Street, right, okay. Offers the most in-depth financial modeling courses, right? Breaking into Wall Street. I'm not thinking that high. Let's go certification, interesting, CFI, right? Breaking into Wall Street, that's an interesting term. Views. Breaking into Wall Street. Derivatives, they come financial security, right? Up or driven from an underlying asset or group of assets, like stocks, like Nasdaq and S&P 500, and bonds, which are government held, and dividends as bonds are a type of dividends, right? Bonds are a type of dividends offered by the government. Let's see. The bonds are not typically considered a form of dividend offered by the government. Bonds are debt securities where investors lead money to the government, and in return, the government makes periodic interest payments called coupons and eventually repays the principal amount at maturity. Dividends, on the other hand, are payments made by companies to the shareholders representing a portion of a company's profits. Right. So this is for shareholders of a company. So dividends are only for the shareholders of a company. The dividends are let's say and then on the other hand we have the bonds, which are debt securities where investors lend money to the government, and in return the government makes periodic interest payments called coupons, eventually repays the principal amount at maturity, right? So debt securities where investors lend money to the government. So let me say, so we have bonds, the money investors lend to the government, the bonds are the debt security, money investors lend to the government, which the government pays back periodically with interest, and eventually repays the principal amount at maturity. Okay, cool. Let's see if I can get an image for this. Oh, cool. This is a really good picture right here. So let me just copy this And let me grab this. Let me just paste this with this. Let me copy that. No, shit. Copy that, paste that. Yeah, I'm saying, stab it. Let me just delete this real quick. Alright, so let's go to quantitative method. Methods involve collecting and analyzing numerical data to understand phenomena and test hypotheses, right? Phenomena is a sort of observable events in or facts in nature or society, right? So it's like observances. Let's call it observances. Observances. I can't even spell that. Collecting and analyzing numerical data and understanding phenomena observances. So it's basically like hedge funds or people who predict the future in finance. GDP, gross domestic product, measures the monetary value of a final goods and services, that is those that are bought by the final user / produced in a country in a given period of time. Nominal in existing in the name only. So there's nominal GDP and then there's real GDP, right? So existing in name only is nominal GDP. Okay. So this is the financial that is. So let's simplify this a little bit. So let's say GDP is the measure of good is the monetary value of final goods and services, that is those that bought by the final user produced in a country in given is the final outcome money of the goods and services bought by people produced in a certain country in a given period of time. Much more simpler definition, isn't it? All right, let's go. Econ phase, right? Sorry, my bad. So this is just a financial mastery part. You can take a look at it. So this is return on equity, and this is return on assets. So gross margin, net margin. So see the difference between these two. What is the difference between gross margin versus net margin? Let's see. Gross margin focuses on profitability of a product or service, while net margin considers the overall profitability of the business, right? Gross margin focuses on the profitability of a product or service, right? While net margin considers the overall profitability of a business, right? So net, like it's like the net worth type of thing, right? So gross margin profits, right. Okay, so it's a gross margin versus the percentage of revenue remaining after deducting only the costs of goods sold, whereas net margin measures the percentage of revenue remaining after deducting all expenses, including COGS, that's the gross margin, cost of goods sold, and other like operating expenses, interest, and taxes, right? Okay, so it's after everything is accounted for. After everything is accounted for, including debt, interest, expenses, overhead, costs, etc. Let's move on. All right, so let's move on to that. So it's a return on assets is a financial ratio that indicates how profitable a company is relative to its total assets. It's commonly expressed as a percentage of using a company's net income and average assets. A return on equity, on the other hand, is a key measure of a company's financial performance. It is calculated by dividing net income by shareholders' equity, since shareholders' equity represents a company's assets minus its liabilities. ROE is effectively measures the return on net assets. So, okay, return on equity, right? ROE effectively measures the return on right. It's a ratio that indicates how profitable a company is relative to its total assets. It's commonly expressed as a percentage of using a company's net income and average assets. Cool, interesting. So let's move on. As a turnover, so turnover ratio is net sales over average total assets, right? Inventory turnover, right? So let's move on. Leverage buyout, I've talked about this before. Enterprise value, it measures a company's total value. Its calculation includes not only the market capitalization of a company, but also short-term and long-term debt, as well as any cash or cash equivalents on the company's balance sheet, right? Is a portion of a company's share price to its earnings per share. Share price per, right? Price to earnings ratio, right? This ratio is a portion of a company's share price to its earnings per share, right? Enterprise value measures a company's total value. Its calculation includes not only the market capitalization of a company, but also short-term and long-term debt, as well as company cash or cash equivalents on the company's balance sheet. How much money is needed to purchase the whole company? So enterprise value is how much money is needed to purchase the whole company. The current share price multiplied by the number of outstanding stock shares is the market cap. To purchase the whole company, you need to purchase all its shares. Total debt is the sum of short-term and long-term debt. You will also need to pay off all the company's debt. Cash is the liquid assets of a company. Cash reduces the price as you can use it to pay down debt. Right. Leverage buyout, once again, acquiring another company by borrowing money from borrowing money to buy a company, often using the company's assets as collateral, just in case it goes, bad. Repaying loan, so you get the loan, you buy the company, you repay it with the target company's revenue, and you make the profits by, selling it. Exit. Black-Scholes model assumes that the market consists of at least one risky asset, usually called the stock, and one riskless asset, usually called the money market, or cash or bond, right? So cash, bond, money market. Cash or bonds are safer assets, more stable assets compared to stocks, right? Which is the risky asset, right? So a sensitivity table highlights the base case and the range of possible outcomes. So as you can see, we have the operating profit, we have the bicycle sales volumes, and the number of units, So you can see that we have a lot of operating profit here, and so price per bicycle. And let's see, we have this. Okay, bicycle sales volume. Right, okay. Right, okay. Scenario analysis is a technique used to explore the potential impacts of various future events on a system, organization, or investment by considering different plausible outcomes. So assess the scenario, what's the future value, or of portfolio cash flow, or business based on future events or factors or multiple scenarios affecting the growth and profitability, right? So there's a technique is to explore the potential impacts of various future events on a system, organization, or investment by considering different plausible outcomes. So portfolio theory, a mathematical framework that's used to build a portfolio of assets that maximizes the expected return for the collective level of risk. If you want hype and jobs or like, right. Man, what the hell? Okay, so this is like that machine learning thing. 100% bonds. So I'll take a look at this in my free time once again. Right, so risk management is the process of identifying, quantifying, managing, or mitigating potential risks faced. Hedging is the purchase of one asset with the intention of reducing the risk of loss from another asset. So you can see that helps reduce losses. Making informed decisions is a process of identifying, analyzing, and controlling financial risks. Strategies, hedging, diversification, and insurance, right? These losses making for process of controlling financial risks. Strategies, hedging, diversification, insurance, right? Right, so these are the financial risks, different types of risks, and process of identifying, quantifying, and managing, mitigating posture. Icon hedging, right? Yeah, we looked at it. Theory of markets. Is this all? The theory of markets is more precisely concerned with determining the prices and outputs of goods and services, as well as the pricing and use of inputs of production. So you can see, look for balance, efficiency, and it's efficient market. Demand exceed supply exceed demand, and imbalance occurs, right? So demand occurs, and look for balance, efficiency, and then efficient market. Right, auction market theory. The theory of markets is more precisely concerned with determining the prices and outputs of goods and services, as well as the pricing and use of inputs of production. Price earnings ratio is the stock price divided by the earnings per share. Return on investor capital indicates how efficiently a company puts the capital under its control towards profitable investments, right? How efficiently a company puts the capital under its control toward profitable investments or projects, right? Return on investor capital. Return on investor capital. So you return the return you get on investor capital. So company puts the capital under its control toward profitable investments and projects, right? So once again, we have this equation, the return on investor capital equation. So EBIT is, I think EBIT stands for EBIT finance. I think it stands for earnings before interest and tax. Earnings before interest and tax. EBIT is earnings before interest and tax. Earnings before interest and tax, right? EBIT. EBIT is earnings before interest and tax. Return on invested capital. Return on invested capital. So let me just type this out. Practically, return on invested capital. And let me just type this as well. EBIT is earnings before interest and taxes. See? So 10K report. Formal is an annual financial report. So let me just try to simplify this down. So let's say, for example, it's an annual financial report that publicly traded companies, the USA, must file with the Securities and Exchange Commission, SEC. Okay, it's an annual financial report that's publicly traded. Report that publicly traded companies in the USA must file with the Securities and Exchange Commission, right? So it's an annual financial report. So 10K report is an annual financial report, publicly traded. Wait, one second. So 10K report is an annual financial report, publicly traded companies in the USA must file with the Securities and Exchange Commission. So every company in the US, so let's make this a little more simpler. Every company in the US must annually report this annual financial report to the every publicly traded company. Every publicly traded company must put this in the USA. Must report this annual financial report to the Securities and Exchange Commission. And it's called the SEC. And yeah, that's pretty much that. Accretion and dilution. Analysis is a financial investment used in mergers to determine if a deal will increase or decrease the acquirer's earnings per share, right? So accretion is increase and dilution is decrease. Analysis is a financial mergers and used in mergers and acquisitions to determine if a deal will increase or decrease / decrease the acquirer's earnings per share, right? EPS. EBITDA stands for earnings before interest, taxes, depreciation, and amortization, right? So amortization is the expensing of acquisition cost minus the residual, what remains after most of something is gone, value of intangible assets in a systematic manner. So econ dividends are only for the shareholders of a company the pay that they get. Ones are the debt security money investors lend to government, which the government pays back periodically with the interest and eventually repays the principal amount at maturity. So as you can see, we have this diagram right here. So shareholders receive cash dividend. Stock dividend companies give existing shares to shareholders. So everything just paying back the people. People that are part of a company. That's dividends, and bonds are the debt security money investors lend to the government, and they get paid back. And they get paid back periodically with interest, and eventually pays more at. Eventually repays the principal amount at maturity. So let me just show you guys something. So we're gonna do something like this. We're gonna simplify this a little bit more. Ones are the debt security money investors money lend for debt security to the government by investors which the government repays periodically with interest and eventually repays the principal amount at maturity. Simple definition. A gross margin focuses on profitability of products or service, while net margin focuses, let me divide this while net margin considers the overall profitability of a business after everything is accounted for, right? Including EBITDA. So yeah, that's pretty much for econ. Now let's look at the business part. So old ones, let's see. Don't mind that. Yeah, so don't mind these. I don't think we have anything. Yeah, this is the usual. Just in case you want to look at this. just in case you want to see this. Just in case. Don't mind that. Just in case you want to see this. Just in case you want to see that. So we don't have anything important until about this is the usual theories, marketing theories, as you can see. Once again, if you want to take a look at this. So holdings is a business that owns shares in other companies to control them and manage their operations rather than producing goods or services itself. The term can also apply to personal portfolios and institutional investments. Right. Holdings can indicate a company's total wealth or the various investments it holds for strategic purposes such as diversification, profit generation, or controlling interest in other businesses. This is the suppliers. Don't mind that. But let me show you guys something else. There's if you want to take a look at this, you can take a look at this as well. You can take a look at this. Everyone I could possibly work with, subsection of the market. Who I can specifically target to speak to. And boom. Let's move on. Let's move on. So this is investments, borrowing money to borrowing money to have more cash to invest, right? So you can invest in stocks, bonds, real estate, invest in your own business, into your other businesses, that's private equity. Your money, other people's money, equals bigger investment. It's pooled investments. Computers, that's code, leveraging code, software, in other words. Higher leverage, you get more output for the same input. So code, media, capital, which is of course needed, labor, which is the cornerstone of everything, and once again, social media marketing. So we have business maths. Just don't mind this. I just took this off Instagram. Freelancing, once again, little things. In realistic syndication, education and clothing, cashier systems, it's required for any business. This is venture capitals, so venture funds versus angel investors, solos, or pooled investments. So long short equities, classic hedge funds, that longing is buying and shorting is selling. Global macro is betting on entire economics. Quantitative trading, nerds, supercomputers, so this is a bunch of data and algorithmic trading. Event driven, profiting from chaos, very risky. That's long short betting. So a turnover rate in human resources turnover refers to the employees who leave an organization. 5 forces is power, price, place, promotion, and product. Product, price, power, promotion, and what was it? No, it wasn't 4, just 5 forces. I don't think so. Yeah, so it was like, right. It was different. My bad. So let me show you guys. Threat of new entrants, threat of substitutes, bargaining power of buyers, bargaining power of suppliers, rivalry among competitors, 5 forces model, right? Very important stuff. So this, our Porter's 5 forces. I think I should get this as a new message. Put that here. That's essentially doing a competitive analysis on a higher level. Resource-based theory suggests that resources are valuable, rare, difficult to imitate, and not substitutable, best positioned in a firm for long-term success. Right? Exactly. So it's like blue ocean strategies. Oligopoly is a market structure with a small number of firms, none of them which can keep others from having significant influence. Right? See? Demand is elastic and sensitive to price increases. Demand is inelastic and hard to respond when prices fall. Right? So quantity units and the price. So once again, economic cycles, expansions, when things are going up. Peak, top of the right, contraction, things are going down. Trough, the lowest point. It's a boring work that makes money. These stuff right here, if you want to take a look at it. And boring businesses, as you can see. And this is another thing. The 6 Sigma concept, so that's gathering data and understanding, analyzing, improving, controlling, and sustaining. So, ensuring improvements are not only achieved, but are sustained longer term, right? First, the statistical concept of achieving a process where the variation is so minimal that it falls within standard deviations from the mean. So that's like how far away negatively or positively are far away in mass data sets from the mean, right? meaning that nearly all products and or services are free from defects. It's widely used in manufacturing, service industries, and other sectors to streamline processes, reduce waste, and that's lean, right? And enhance customer satisfaction. So lean means reduce waste. Let's see. Yes, lean generally means reduce waste and focus on delivering value to the customer, right? So what does agile mean? Agile means it's a core principle of agile methodology where, especially combined with lean principles, is to reduce waste, right? So agile means, what does agile mean? So let's see. In business, a way of working and that emphasizes adaptability and responsiveness to change. An approach that divides work into phases, emphasizing continuous delivery and improvements, right? So this is the Six Sigma. Define what you need, what you want to gather, what you want to analyze from what you gather, how you can improve what you gathered, and how you can control problems based off what you gathered, and how you can do it for the longer term, right? This is the limited liability cooperation, yeah, exactly. Basic stuff. Compliance, again, law, brain drain, people leaving the country, scalability, how many people can I serve? That's scalability, exactly. Without huge increase in costs, especially with software, you can do that. Satisfy forces, as you can see. Patent, a legal right to an invention, with given it right. Giving to a person or entity without interference from others who wish to replicate, use, or sell it. So gross domestic product, or the monetary or market value of all finished goods and services produced within a country's borders in a specific period of time. So inflation, once again, we have the monetary and fiscal policies. As you can see, monetary is from fiscal is obviously government, and monetary is, you know, banks and centralized institutions. Both are coming together to stabilize the economy, promote growth, and short and longer term, right? So as you can see, we have a nice chart over here that represents it. And enterprise resource planning, lean and Six Sigma together. Lean makes it efficient, Six Sigma makes it perfect, right? So as you can see, lean Six Sigma is lean makes it efficient, so it reduces waste, and Six Sigma makes it perfect, right? By analyzing data, right? Collecting data, analyzing it, and then making it sustainable for the foreseeable future. See, speed and efficiency. Six Sigma, quality and accuracy. So do it right every time by understanding data, right? DMAIC, define, measure, analyze, improve, control, right? DMAIC, define, measure, analyze, improve, and control. So define what's the problem, collect what the data is, and define the cause from the data, improve it, and then control it from breaking again for the sustainability, right? So reducing defects, exactly, and then data-driven decisions from, and then, you know, do that. Okay, so Sigma, yeah, exactly. So Sigma. So right, exactly. Reducing waste of time in this case. And you check why one other. Exactly. So data analytics. Business leadership. Autocratic is leader decides alone. Democratic is shared with a team. Transformational is vision led. Transactional is task reward focused. And whatever this is, let's call it fair. Fair is team led, right? I can't even pronounce it. So see, inclusive and fair. Motivational and visionary, and transactional is structured and rule based, and hands off and trusting. Experts who need little direction. Sales performance environments, inspiring change and innovation, team collaboration, motivation. Emergencies, strict environments, right? That's one. Opportunity cost, what you give up to choose one thing over another, and that's what the missed out thing. That's your opportunity cost, right? Oligopoly, other institutions can't you know, have significant influence over other institutions. So collusion is when companies secretly are going to cooperate instead of competing with each other. Usually to keep these prices stable. It's illegal in most countries because it keeps competition and hurts consumers. You don't drop your price and I won't drop mine. We'll both make money, right? So as you can see, collusion, net present value is the absolute value of a project by discounting future cash flows to their present value, while the internal rate of return determines the rate of return that the market that makes the NPV equal to 0. IRR is the discount rate that makes the net present value of all cash flows equal to 0 in a discounted cash flow analysis, right? So let me show you guys this. As you can see, so net present value and the internal rate of return, right? So this is to understand how much money can I get back from this project. Operations, and as you can see, supply chain, reduce waste, make the most out of the data, and for the future, for the future. And that's why we're collecting data. Inventory management, not too much, not too little. Quality control, ensuring consistent product and service, quality of the product and service. Inventory management, not too much, not too little, right? Process optimization, making business systems more efficient. So this goes back to Six Sigma. Supply chain, once again, flow of products from raw materials to customer, right? So distribution chains, and distribution networks. That's what I was gonna say. And warehousing, production, suppliers producing and then shipping it to distributors, sending it to, transporting it, and it's from there to shops for retail, and then to the consumer, which all depends on quality of the product or the service. Inventory management, reducing waste, that's lean, and Six Sigma is collecting data, right, and reducing errors and waste once again. So yeah, lean and Six Sigma, Maslow's hierarchy. So let's see what these stand for. Maslow's theory focuses on fulfilling basic needs, while Herzberg's theory focuses on the factors that lead to job satisfaction. Right. So, right. Okay. So let's say Maslow's theory focuses on fulfilling basic needs, while Herzberg's theory focuses on the factors that led to job satisfaction and dissatisfaction, right? Let's just say this. Theory focuses on factors, on the factors that led to job satisfaction. So just right. Entrepreneurship and minimum viable product, pivoting, changing direction based on feedback, founding stages, bootstrapping, seed days. So bootstrapping is funding your own thing. Seed series. So that's the initial investment point where you pitch, and seed A, and then seed B, like that. So this is when you want to list your company on stock exchanges, acquiring and merging. So that's exit strategies. IPOs, initial public offering. Corporate governance, once again, contracts, intellectual property, corporate governance, how companies are structured and controlled, ethical decision making, doing the right thing even when it's hard, compliance, following the rules and regulations, HRM, which is human resources, recruitment and selection, training and development, performance management, compensation and benefits, workspace culture, values, environments, and employee satisfaction. So we use the key performance indicators, predictive analytics, machine learning, dashboards to visualize, and business intelligence using data. Once again, machine learning. So first mover advantage, being the first mover. So this is a blue ocean market. Network effects, products get more valuable as more people use them. Sunk cost fallacy. If you don't keep spending just because you already spent, disruptive innovation, new ideas that replace over the industries, right? Like Uber for taxis. So let's go for unit economies, analyzing the profitability per unit sold, customer acquisition cost versus customer lifetime value. So this is like Gucci and Louis Vuitton, and this is the usual businesses. Customer lifetime value is greater than the customer acquisition cost. So in Gucci and Louis Vuitton, they spend more on acquiring the customer. So with marketing and stuff, so quality of products and stuff like that. Horizontal versus just one vertical scaling. Cognitive bias is where the pain of a loss is felt more strongly than the pleasure of an equivalent gain, right? Where the pain of a loss aversion is a cognitive bias, where the pain of a loss is felt more strongly than the pleasure of an equivalent gain. This means people are more motivated to avoid losses than to acquire gains, leading to potential decision-making errors. Right. So you don't want to lose anything, but you want to gain. No risk to reward. It's impossible in this world. Fixed income instrument that represents a loan by an investor or borrower, typically by corporate or government bond, that security insured by government support, government spending and obligations. Assets versus liabilities. What gives you money versus what takes it away from you. No, this is not really an asset anymore. So in Sri Lanka, this is actually an asset, but it's mostly a liability because it takes more money from you. So in a business context, yes, it's an asset. Working capital. So as you can see, current assets minus current liabilities. That's a working capital. Price elasticity. How people react to drops in price, and if it stays consistent, then it's inelastic. Shareholders. Equity share versus stakeholder, people who are directly involved in the business. should serve all stakeholders, not just shareholders. Once again, supply chain management, logistics, inventory, production, and supply relationships. As you can see, equity ratios, corporate governance, it's just like a healthy financial position. The system by which a company is controlled and directed includes both structure, rights of shareholders, and accountability and ethics, right? Capital budgeting. We've looked at these payback period, so that long-term projects or companies should invest in. Smart leaders simplify choices and automate routines, right? To make decisions, poor choices later in the day. Smart leaders simplify choices and automate routines. Key performance indicators versus objective key results. Goal setting that aligns teams with big objectives. Metrics to measure performance. Total revenue. Yeah, customer lifetime value. The lifetime of a business helps in deciding how much to spend on acquiring customers. It's been how people actually make decisions, not just how they should. Emotions, habits, biases all play a role. Loss aversion. We hate losing more than we like winning. We hate losing more than we like winning. It's loss aversion. The cognitive bias, where we fear loss than gain, right? So gold melted mixed with other metals turned to jewelry. Once again, supply chain management. So sales and product development, procurement, suppliers, manufacturing, warehousing, logistics, and finally the consumers. And it goes into the shareholders' pocket. They invest back in the company. Something like that. Key performance indicators or measurable values demonstrate how effectively an organization, team, or individual is achieving business objectives. As you can see, relevant, time-bound, specific, measurable, and attainable, right? So once again, just continue small improvements with employee involvement. Focuses on eliminating waste and improving efficiency and value creation. Focuses on reducing defects and variation in processes using data and statistics for Six Sigma. Like I said before, thinking about it, how am I feeling about my situation? What am I doing about it? Raw material supply, manufacturer, distributor networks, wholesalers, retailers, and the end user. Once again, diagrams. Sorry about that. Difference between liability, debts of obligations, person owes, company owes to someone else. Forecasting is making predictions based on past and present data. Capstone is used to final decorative coping, or capstone used to complete a building or monument, right? Something that's very important. Final decorative coping or capstone used to complete a building or monument, right? Supply chain management, right? So, right, and then this guy is going to reverse product flow and primary cash flow, right? Primary cash flow, supplier, right? Information flow, reverse product flow, right? You collect data about it between the present value of cash inflows and present value of cash outflows over a period of time. So I'll just go through these quickly because I've been recording for an hour. Scan crisis management. How to deliver. This is commission-based marketing, delivery channel, marketing channel. You get the point. So yeah, that's pretty much that part. Work in small chunks, test, show it to the customer often, improve as you go, get the feedback, build, get the feedback, improve it, and repeat. Like this. Lean canvas, right? That's reducing waste. So lean is reducing waste. 1 plus R times N once again, net present value, over CF. That's the net present value. It's also DCF though. But in this case, it doesn't change over the years, so that's why it's the net present value. But in the discounted cash flows, every year, this is a different number. Once again, we looked into these: supply chain management, key performance indicators, and objective key resources. What was it? Objectives and key results right here, as you can see. How are we going to do that? Objectives and key results. Once again. And scorecard, financial business process, customer. Drive strategy, business actions, and behavior after. right? So I'll just go through this real quick. Forecasting is just, finding data and visualizing it. Supply chain management once again. Supplier, manufacturing, distribution, right? What is 5 forces? That's a new entrance. Substitutes, bargaining powers, power buyers, suppliers, competitive rivalry. As you can see, it's like a competitive analysis, enhanced one. Identifying and planning, choosing and selecting suppliers, negotiating the contract, for planning the first purchase order, accelerating the order, receipt and inspection of purchase, clearing the invoice and payment, maintaining relationships and records. So procurement management. So what does procurement mean, right? What does procurement mean? The action of obtaining or procuring something. Process of sourcing, purchasing, receiving, inspecting all of your goods and services your business needs to operate. Everything from raw materials to software supplies, right? So process of acquiring necessary goods and services required to create a business or create products, right? So once again, this is fiscal, and this is this is all more fiscal. See, this is monetary, this is fiscal. This is mainly from governments, right? It's fiscal, as you can see. Fiscal is the government. The government is fiscal. Imagine like that. Fiscal government. What a fiscal government, bro. Expansion, peak, recession, boom, crash, rebuild, go all the way to 0, and then repeat. Microeconomics. Supply and demand. This is the usual. Elasticity. Opportunity cost. Game theory. Business dilemma. Best individual choice may not be the best for the group, right? So you need to be aligned with other people's ideas, not conflicting. Marginal utility. Each additional unit gives you less satisfaction. The size of pizza. Amazing. 5th May. Okay. Comparative advantage. Countries should specialize in what they do best and trade. Even if one country is better at everything, their trade still benefits both. Exchange rate. How much one currency is worth in terms of the under. Arbitrage. Imports, exports, travel and investing. Balance of repayments. Records all of all economic transactions with other countries. Goods, services, income, investments and loans, right? So once again, concepts. Quantitative easing. Central bank prints money to buy assets, increases money supply. Used during to encourage lending and spending. Crowding out government borrows a lot, may push up interest rates and reduce private investment. Moral hazard. If people are protected from risk, they may take more risks. Banks may behave recklessly if they expect bailouts, right? Liquidity trap. When interest rates are low, people still don't spend. Treasury monetary policy becomes useless. Stagflation, high inflation plus high unemployment at the same time. Very hard to fix since solving one worsens the other. Laffer curve shows that after a certain point, raising taxes decrease total revenue, right? So raising taxes decrease total revenue. This is something that happened to my own country, right? The Laffer curve. If the taxes are too high, people stop working or evade taxes, right? So, I mean, it's not that bad, but you get the point. Shadow banking system, non-traditional banks or doing financial stuff like hedge funds, investment firms, risky because they're less regulated, but still very influential, right? Non-traditional banks doing financial stuff, right? Like hedge funds, investment firms. They're risky, but very influential because they still make individuals more money. VC funding, virtual venture capital, crowdfunding. That's, equity pools, corporates and seed funding. So that's once again venture capital. Angel investors, individuals, incubators. I think incubators. What does incubators and accelerators mean? Incubators provide the environments and resources to help your ideas succeed. Accelerators compress years worth of learning and growth into the span of a few months. Right. The more you learn, the more you earn. As you can see, start of funding stages. So let's just call it this. And let's get a picture of this. And incubators and accelerators. Perfect. So let's grab this one. Boom. And let's go back. So there's a business bets. So bonds. IOUs spending. IOView. Okay, IOView. Investor IOView. Orwell lends pays plus interest. Issues bonds, governments mainly. Right, so these are marketing theories. These are industries in my country. Export focused business. Social impact on niche opportunities like tourism, Ayurveda, and tea exports. Knowing what not to do is better than knowing what to do. Finances. Used in whole homes, paying to rent, common vehicles, business equipment, or office space. Type of finance is specifically for homes. Using the car personally, the car is not used enough for business. You can keep, right, this tax write-offs. Surplus cash refers to the excess cash a company has after meeting all its operational capital expenditure and financial obligations. Dividends, yeah, right. Equities, treasuries, unit funds, private wealth management, external assets. So as you can see, where you invest in stocks and money to government, get interest, which is low risk. That's bonds. Pooled money invested by experts, diversified and easy. Experts manage your money personally as a premium service. Invest in foreign markets outside Sri Lanka. Okay. Agency theory hires and assigns work to agents, right? And they perform on behalf of the principal. It's like the CEO. Original equipment manufacturer, original design manufacturer. So this is like brand design, full customization, high investment research and development, right? Faster time to market, customization options, standard designs used by many, right? Private label is one that is a product is one that a retailer gets produced by a third party but sells under its own brand name. Blue collar jobs, once again. White collar jobs, just in case. Pink collar jobs. And once again, we see this. Actuaries analyze the financial cost of risk and uncertainty, as you can see. And tech money, this is if you want to take a look at this. Tech future, if you want to take a look at that as well. If you want to see the strengths of Sri Lanka, tea and spice exports, high quality precious gemstones, BPO and outsourcing, tourism, textile and garment manufacturing, as you can see. And these are how much clients make, people make. So highest paying jobs, as you can see. And actuary is a risk management professional who uses, right? Well, we've looked at this. So this is what most of those what do you call those countries? Oil money people who do. And yeah, this is investment banking. Once again, if you want to take a look at it. And if you want to take a look at this slide as well, as you can see. And certify, okay. Subscription models. Licensing and compliance. Business plan. If you want to take a look at this. Legal license and traditional TV. If you want to take a look at this. As you can see, cars, what not to buy. (3PL), third-party logistics. So your business ships to finished products. Your business ships finished products to a 3PL warehouse, and 3PL warehouse receives products and logs it into stock. E-commerce orders go directly from all your platforms to a 3PL provider. Orders are picked and packed by a 3PL company. Orders are shipped as soon as they're ready, and orders are delivered to your customers, right? Tracking the financial transaction of a business, it's bookkeeping. It's the process of preparing tax returns, often in taxing income tax returns, often for a person other than the taxpayer, generally for compensation. Table accounts payable represents the money a business owes to its suppliers for goods or services they purchase on credit. While accounts receivable represents the money owed to the business by customers for goods or services provided on credit. A financial analysis report shows the financial performance of your business over a specific period of time, usually on quarterly or yearly basis. Let's move on to the last one. So a financial modeling is a set of numerical techniques used to forecast a company's future growth, right? So as you can see, we have the three-statement model, which I believe is a three-statement model. Finance. So let me show you guys. So income statement, balance sheet, and cash flow statement, right? So the three states for income sheet, balance sheet, cash flow statement. So let's call it the three statement model. Okay, I've already listed it. I'm blind. Income statement, right? So I think if you want to take a look at this, enterprise resource planning, as you can see, human resource management, material resource planning, and things like that. Material requirement planning. Computer is pretty great. So mass production companies. Revenue, exactly. As you can see. Don't mind that. Model that helps a company be socially accountable to itself, stakeholders, and the public. And see that? Build, form, enlist, enable, generate, sustain, and institute. Reduce waste, reduce defects and variation. Using data, show it to the customer, improve, and get feedback quickly. Strengths, weaknesses, opportunities, and threats. Political, economical, social, technical, environmental, and legal problems. Culture's 8 steps. I think I've done now. So yeah, I mean, as you can see this. Human resource management. Cool. So if you want to take a look at this. So yeah, incubators provide the environment and resources to help your ideas succeed, and accelerators compress years worth of learning. Accelerators compress years worth of learning and growth into the span of few months. Cool. All right, we just went through all the slides. It's been like 1 hour, more than 1 hour. So yeah, thank you guys so much for watching. This video is going to be up by tonight, and I'll see you guys in my next one. Peace out.